All right, let me run through this video pretty quickly. Yes, gets a little bit boring. It was like 25 minutes last video, so I'm gonna go quicker. Just gonna run off the list. I think by the summer we will see about 30% unemployment in most Western countries, maybe all of countries actually. Be a really hard melt here. People are not working, businesses are not open. It has a chain effect, like things are happening. You're not allowed to go to work as your waitress, you're not making money, you can't pay rent. It affects the landlord can't pay the financial institutions for his mortgage. The bankers gets fired. It's just like whoa, 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 whoa. Things are happening in a sequence. Like I said in the last video, I think the way out of this is the Andrew Yang stuff. Like, you need to give people money, because the opposite way around, like Obama did, which was giving the bankers money, this means that the bankers have money to buy the stuff of the people. It's not like they intended by the Austrian School of Economics. It just works in a university, in the head of the academics. It doesn't work in the real world. So Andrew Yang stuff would work in this situation. I'm not pro or against that stuff. I don't have any opinion on that stuff. I just think, like, if you just wanna put the economy on survival mode, we're not talking about, like, we're not flourishing. We're gonna get screwed anyway, but it's gonna get not as bad if everybody gets $1,000, $2,000 a month. The whole world is closing down. Everybody I'm talking to all over the world is closing down. I think this be a 2 years thing, because and people ask when to buy and stuff like that. People need to get depressed. Like, in situations like this, maybe this is like the thing out of our lifetime. It probably is, people need to get depressed. Like, really, really, the bottom is way lower than we're currently at. Because, like, depression works like, like, if you've been depressed for a week, it's kind of easy to go back to the optimism. This will kind of recircuit the brain in some sense, so people will get depressed, like they will be stuck in that wired frame. And that will be great for our people who wants to buy really cheap, because these people who get depressed, they won't see opportunity. So there will be a lot of opportunity that people won't take. Just like people jumped on any opportunity the last year, right? What I'm currently doing, I'm trying to figure out how to move large sums of money from Schwab to Coinbase. I'm looking at Coinbase Pro. I want to get into Bitcoin. I think there will be a time for that in about 2 weeks. There is one way to buy Bitcoin correlated funds on the stock market, and it's called GBTC. If you look at that, GBTC. But they have like a 2%, and you don't hold it in your name. It's not something I like. It's something I would run to if I'm in a really stressed mode and I feel like there's a 5-day delay between moving money from Schwab into Coinbase, or 10 days or whatever it be. That is something you can do immediately, So, I made my purchases over last week. I basically left Uber, Lyft, and hotels, which was like Wynn and Wyndham, and that was previously in cruise ships. And should we go over the junk bonds now? I think that's a good idea. And we have some questions on it here too. The junk bonds, let's do the question first. Do you consider ETF that have their money in corporate bonds that are of lower medium grade? From what I see, amounts outstanding have exploded over the last few years. Once these bonds lose their investment grade label, they should plunge as well. So when it comes to corporate bonds and they emit bonds, I'm not trying to preach. I'm just trying, for the people who are not aware, I'm trying to explain the basics of it so everybody can follow this video. There's level tiers of bonds. So a company, they give out a bond saying like they don't have money, they need to borrow money, so they give out a bond. People buy these bonds and then they get a return every month. It's basically you buy a investment where you get a bit of return. And there's been really, really bad bonds out there, like really, they call them junk bonds. And these junk bonds, they're completely screwed. They were always screwed. They didn't have cash flow as it was in the best period of like over the last year. They didn't have cash flow to service the debt on those junk bonds. We're talking about like big corporations and small corporations too. So they really admitted new bonds to pay and service the interest rate of their own old bonds. It's absolutely insane. And that was in good times, and now we're getting in bad times. So there's a reason why I'm not interested in, they call them investment grade bonds, and they call below quality junk bonds, investment grade bonds should be considered like the kind of safe. They get lower return, but they're safer. And the question here kind of insinuates that these ones are gonna go, they're really bad too, and I agree on that. Like I 100% agree. The reason why I don't do it is that, first of all, I didn't find any investment grade bond that had the same return on money. Like the one I found made 20-30% return on my money, looking for a 3 months time period, and with an expiration date of about 3 months. That's pretty good. It's like kind of low risk and insane return. I just don't find that on the investment grade bond. It's probably that I haven't looked enough. It's probably out there. But anyhow, there's more reasons for it. That's the first reason. The second reason is that this bond I found, this junk bond I found, high yield corporate bond, it had a lot of volume. And now I'm moving millions of dollars. And if you don't want to push prices upwards, which I do now by 25% when I go into this, but if you don't want to push them up like hundreds of percent, like you need a lot of volume to go into such position, because it's not that liquid. You'd be surprised. You think it'd be like a big market. It's really not. And the third reason, which is the most important reason, is that the sequence. I'm all about the sequence. I started on cruise ships in this downturn. I did things before that. This is not my first rodeo, but I started on cruise ships. I rode them down. I don't ride completely down, because if you're waiting for the last 50-100% in a bear market like this, you're just trying to squeeze something out that is like kind of like you have something else. So what I did was I jumped from cruise ships to airlines, because airlines had more to give, and it turned out to be fantastic, absolutely fantastic. So instead of like getting like that extra 100% out of and waiting another week on the cruise ships, I maybe got like 500% jumping to the airlines. And now I left the airlines for the high yield junk bond. Not completely, I'm still a big position in Alaska, but maybe some diversification, you would see that. So my third reason to not go into high grade bonds, which I think will take a tumble too, is that I think the first one to happen now is for the junk bonds to lose their value. I think people would go like, holy fuck, like these junk bonds, they're not gonna service their debt, they can't refinance. It's like, it just makes sense that it would be the first thing that the market would freak out about, and it would be the first thing to tumble. And it could even give me the possibility to go from junk bonds to investment grade bonds and do that jump. And then you like, if you get 10% here on junk bonds and then 10%, 10 times, sorry. It's crazy market, I know. You get 10 times on a junk bond, and then you get 10 times. It's much more than just like getting 10 times once, right? So sequence is everything, because if you go into investment grade bonds, like you have to wait out junk bonds, and then it's your turn basically. But what I believe is that we're gonna get junk bonds, and I'm not so sure about the dollar, I'm not so sure about the currency. I think there might be a run for gold very soon. I don't know how soon, but that's why I'm like a little bit stressed. I don't want to miss a week. I don't want to miss 2 weeks. So as soon as I rode junk bond down, I'm jumping into gold miners, calls of gold miners, and I'm jumping into Bitcoin. And I expect to see this high grade junk to do 20 to 20, maybe 15 to 20 times. That's how the bond looks now, because it's like if they go down half the price, and money keeps flowing out of the ETF like freaking crazy. So like I don't understand how the price stands up. There's always some mechanism like that, and then you come to a point and then it breaks and then prices comes down. So I'm really happy I picked it up yesterday on Monday and on Friday, and it's already moving a little bit. So yeah, I want to do a quick thing on the shorting as an industry, because I don't feel like many people really understand the concept of shorting, and even I didn't understand it fully, you know. And I came up with an analogy for it, and it's like shorting is like to be in the insurance industry. It's like the opposite of risk taking. People think it's like risk taking. It's not risk taking, at least if you know what you're doing. Like imagine you live in like a place like this in the Caribbean, and a tornado is about to hit, or they call hurricanes here. And while everybody's paralyzed and they're either in a state of denial or they're in some panic mode, you call your insurance agent and you say like, hey, I like full coverage of my house. That's what shorting is. Now, if you're in put option, which is like an extreme version of shorting, it's an extreme version of insurance, then you could make the analogy like you don't own a house. You're like, here, I'm renting a house, and but I still buy an insurance for the house. It's not my house, but I buy an insurance. So if this blows down, like they pay me for a new house. And in fact, I don't even only insure this house. I insure the neighbor's house, my other neighbor's house. And then if I'm right and the hurricane strikes, houses blows down, my insurance will pay me out money for these houses. Now, if I'm wrong, I lose the premium I paid. I paid the price to the insurance agent for the insurances. So it's all about being right. If you're wrong, you lose a lot of money. If you're right, you make a lot of money. And I think right now, you know, like I think now people are facing a lot of hardship, and I think it's like unnecessary. If people have practiced maybe a little bit of stoicism or something like that before, they wouldn't be like in those extreme denial or panic. They wouldn't, you know, the situation hasn't hit yet because people still have money on their account, but they will freak out, they will get depressed and things like that. You know, like if you like every now and then go like 10 days without food, just water, you know, or you sleep in your car for a week, you know it can only get so bad, so you don't stress over situations. And I think like a little bit of stoicism goes a long way, especially when you're a short seller. And I want to add a question there too, that I ask people and that I see like people do not have a good answer, and even like kind of smart people. And I see a lot of people lose a lot of money on not knowing this, because this, well, let's just get fucking to it, sorry. When is the time to sell an asset? People like, when it's gone up 15%, you know, whatever stupid answer people have, right? There's a simple answer to this, when the time is to sell an asset. And as a short seller, or as a business person in general, an investor, there's one fucking answer, and it's when you find something better. That's what it is. So it's like if you're in the cruise ship industry now and you've been shorting that, it's like, okay, you can get another 30% return on your shorts. Like high yield corporate bonds is the right thing to move to, because you can get 1,000%. That's something better. 1,000 is better than 30. So always the answer, when the time is to sell an asset, when there is something better. All right, I'm not gonna go on for too long on this. You guys stay awesome.